Hey guys, welcome back to the Max Spence Business Podcast. Today I have a very special guest, but before I jump into that, if you guys like the content I'm putting out, please like, subscribe, leave a review. It helps out a ton with the podcast and also the people that are coming on the show. If you can, go over to Apple Podcasts and leave a review, that helps out a ton as well. So without further ado, today's guest is actually a returning guest. So his name's Scott Choppin. He's actually, he runs the Urban Pacific Group of Companies, a real estate development firm focused on developing workforce housing. If you guys want to listen to the previous episode where we cover a lot of Scott's background, how he, his family background, how they got into real estate, and how he got into real estate and what his advice is for getting into the development world. That episode is episode 49. I recommend that you guys listen to that one as well. So to give a little bit more detail about Scott, if you haven't heard of him or come across any of his content or his work, crazy guy. Like, this guy's developed over 3,400 units and have exited $900 million worth of projects, that's not a small number. Absolutely really interesting guy, really awesome guy. I highly recommend that you go check him out on LinkedIn. Scott Choppin, go check out his profile. He posts a lot of articles about real estate development that are absolutely phenomenal. Great articles about how to get into development, also about the market, all that type of stuff. So if you're a person that's interested in getting development, I highly recommend you check that out, connect with them, and then also go on to YouTube. And I believe your YouTube is the Urban Pacific Group of Companies.
Yeah, it's under Urban Pacific. That's right.
Awesome. Yeah, I highly recommend that you go check out that as well. They got tons of great content that's coming out. So why don't we jump right into this? It's great to have you on the show, Scott.
Good to be back, Max. You're in the 80s now, right? On your episode.
Yeah.
So
I
get to come back when you doubled.
Yeah.
For me.
It's always a pleasure having repeat guests on. It's always a pleasure having someone such as yourself, because you bring so much knowledge and you've done so much in the development space.
I appreciate that. Happy to be back here. Excited.
Awesome.
Yeah.
Awesome. So, why don't we just jump into a recap of what have you guys been up to, what sort of projects you're doing at Pacific Group, and what's sort of been happening.
Yeah, so we as we talked a little bit about before, we focus on a type of workforce housing that we created called the urban townhouse. Like, that's the specific project and product and unit type. And that's a 5-bedroom, 4-bathroom, 3-story townhouse rental product. So that fits in a newer market category in the multifamily development business called build to rent. And the reason people call it that is it takes non-traditional housing types and puts them in the rental market. So think single family houses that are built, 100 at a time, and instead of selling them, they rent them. So that would be typical. It fits in that category. All those ours are attached. So we might have row home style, or we are row home style. And I'll tell you that even since we talked, that product category has really taken off. So a couple of examples. In fact, the project we'll talk about today will be Montebello. We've been leasing 2 projects over the last, say, 6-7 months, and we're hitting records in rents, leasing velocities, like how quickly we're leasing the units up, very strong demand. And that's sort of coming from 2 categories: multi-gen families. So think, 6-8, family members, mom, dad, grandparents, younger kids, older kids, which is our primary focus. But we've also had this work from home category, during and post pandemic, that's just exploded. So think 3 or 4 roommates coming together in one of our 5-bedroom units, and they keep, 1 or 2 bedrooms as work from home space, like a home office, and our units are bigger. And so that's appealing too. So I'll share with you, we're in the process of raising capital on a $60 million equity fund that'll be called the Urban Pacific Workforce Housing Fund 1. And that'll be a $60 million equity raise that will then turn into somewhere around 180 to 200 million of this specific UTH product type all throughout Southern California. And so this is our pool of capital that we'll raise to go do probably roughly 16 projects. and then we'll hold those for 6 to 7 years. So I think it just like is a signal that we're firmly committed to this product category. In fact, we're only going to do this housing type, that it's got a really long term, supply constrained marketplace to deliver into, and it takes care of, multi-earner households, which is, huge demand and need, and really serves these families really well.
Yeah, 100%. And that's like, I know last time we spoke, and I've spoken to other like real estate people, and it's been such a push to actually this type of housing being more suburban or being more rural, and instead of, the apartment building, just because of COVID. And I've heard a lot of really interesting takes from it. Like, and I've seen that, I probably mentioned this last time, looking at like the market I'm in with housing, and, rural housing market going up so much. Because there's a demand for people just not wanting to be well, it doesn't really sound that bad, but just not wanting to be around like that many people or stuff, or being in an apartment where you have to go through that. But this is actually super interesting. Just to touch on this subject for a few more seconds. It's the UTH, urban townhouse housing. So were you one of the first people to like really develop and like use this sort of the style of housing where you guys are building the townhouses, and doing like, rental, like turning like, like you said at the beginning, doing, massive, like, track home building where you're building hundreds of houses and selling them. You guys are building hundreds of housings, but renting them.
Yeah, I think so. A couple answers. So one, we're the only company that I can find that's doing the 5-bedroom multi-gen rental townhouse model. So that's the way we really, differentiate, more aggressively, which is sort of like our style of doing business. So we always want to be pushing the edge, innovating, creating uncommon and attractive offers, for our own ownership and the investment capital that we raise. The build to rent model, I think, generally has become like a growing category, because I think that there's pre-pandemic, there was a move for people to want to rent, to rent versus buy, but do it in a format that was different than the classic rental market. So if you were a millennial and you were starting your family and you're starting to have kids, or maybe you have a growing family and you were still in the mode to rent, you wouldn't necessarily live in the studio unit in downtown XYZ, and maybe they were living there before, urban lifestyle, lots of cool stuff to go do, transit. Once you start having kids and have a family, then the need for space gets bigger, like the need to be out at, like in a lower density format, to have more space, more bedrooms. So I think that's what we're seeing demographically, is a shift in millennial, and then Gen Z will follow right on that. And so these are demographic trends that I think we're already in the mode of, changing. And then also, one of the interesting things, and what we really are focused on, is the multi-gen component, right? So historically, traditionally, United States, the nuclear family didn't necessarily, like, when you turned 18, you moved out. Like when I was 17 and a half, like I was out of the house, man. But I think the idea of living multi-generationally is becoming more common and accepted. And think about it worldwide, that's actually the traditional way of living. And so it's becoming more popular, growing here. In fact, Pew Research did a study that we're at the highest rate of multi-generational living in 160 years. So we're at the, like, way long ago was high, it dropped through the 50s, 60s, 70s to the low, and then we're basically coming back up to a rate of, I don't remember what the numbers were, but we've got this growing category of living multi-generationally, and that's both for like just family living, right? Like the feeling of having family around, supportive, but also it's an economic thing, right? Like people live multi-generationally to share incomes and expenses across more family members, more earners. We call it a multi-earner household, as a matter of fact. And so I think it's just, these are demographic trends of people in their specific lifestyle, and time of life for family growth and that kind of thing. And then we have just economic, shifts. And look, the reality is, the US dollar has lost vast amounts of purchasing power really since the 30s and 40s. We could go into the whole Bitcoin fiat, like battle that's happening now. But the reality is the US dollar and fiat currency generally is losing purchasing power. So it starts to push people into either they have to live in inferior housing, or they have to pay much more of their income relative to the price of the housing, or we give them a relief valve in a way to shift into sharing incomes and expenses so they can live a good life, right? Have a new unit, live in a nice unit, have, more bedrooms, more space, a garage, right? A laundry room, but they can do it now affordably. And even in the context of the way incomes and expenses are working in today's environment. So I think we're just watching economic change in real time, and guys like us are like adjusting to, what the new reality is, right? And I wish families could afford, living 2.5, mom and dad and 2 kids and afford a house on a middle income salary, but that's not the reality of it. So when we see that, we go, let's solve that problem.
100%. And I think it was one of the last guests I had on for real estate, or it might've been a real estate podcast I was listening to. And they were talking about this phenomenon, or like effect of like these big funds, pension funds that are going in and buying up hundreds and hundreds and hundreds of houses and are renting them. I don't know if this is true, but it's just something I heard. Okay. And I thought it was like super interesting, because beforehand they would go and, buy like, let's say like a few hundred apartment, like huge apartment complexes or huge, commercial buildings or something. But now they're just buying all these single family homes, right? I thought that was really interesting.
Yeah, in fact, the build to rent market, which is development of new types of projects that are non-traditional to rent, like townhouses, row homes, and single family. The corollary to that is the single family rental market, which is what you're describing, where funds and investors will go in and buy up pools of houses. And that really came out of the great financial crisis, right? Out of 2008, all these homes were foreclosed, and those sort of lived together. And, by the way, that like in California, we have a group of folks called YIMBYs, Yes in My Backyard, which is sort of like housing advocates, tend to skew younger population. And there's a real like resistance to corporate ownership of housing. In fact, so some new California laws that have been put forward to sort of resist or try to offset the corporate ownership of housing, which is seen as a detriment to the renter. And in some cases it probably is. But I also say that these people are buying these houses to rent them versus a homeowner. Well, they live there. And if they did move out and rent it, they have one unit. They probably are not set up to, to provide services and the maintenance and the normal stuff that you have with an institutional owner. So I think there's some disadvantages, philosophically and ethically, but also some huge advantages. And obviously they're profit motivated, right? So that's part of the argument against them, is like, look, these people they don't care. But I quite honestly, one of the things we love competing with single family homeowners that rent. Because they're usually much more difficult to, like, if you're a renter and you're trying to rent that house, the bar to get that unit as a renter is much challenging, because look, these homeowners, they don't normally rent. They don't know how to underwrite tenants as well. They don't do maintenance as well, right? So somebody who's set up to own multifamily and manage it and have it for the long term is set up to do that, right? Like they understand the market, they know people, just the whole thing, like having pets. A lot of single family rental owners, like, no pets, like no way, ever, ever, ever. And we're like, yeah, like, we got to do deposits so we can protect ourselves, but yeah, let's do it. The other one, we're like we regularly accept Section 8 tenants. Like we even encourage that. Some, all of our projects will set aside some units to facilitate 4, 5-bedroom units for voucher tenants. That, like, it's very difficult. Like if you're a voucher tenant and you want to rent 5 bedrooms, we're like one of the only options, if not the only option. Houses are much, much more difficult, and homeowners that rent are much more, resistant. In fact, California just passed a law that says, landlord can't actually, like, not rent to a tenant, discriminate against a tenant if the only discrimination factor is a Section 8 voucher. Like you used to see ads that say no Section 8, like just won't even talk to those people. In fact, they can't
Wow.
do that legally anymore. People are still doing it.
Yeah.
So by our nature of who we are as an owner like these, we're not Blackstone and Colony, all the big guys, but we're a professional owner of apartments and provide the things that, are associated with that you would expect: amenities, services, maintenance, sort of an acceptance and understanding of the marketplace that allows us to be more flexible and creative and having renters move in.
Yeah, no, 100%. And I think it really just comes down to that thing of like there's always going to be bad apples, right? Like I think corporate ownership is going to be great, right? But the thing is, like, if like the reason I think there's a lot more people complain about corporate ownership, because let's say if there's let's say one person who's owning one single family home, that's only one person that's affected. But if you have a corporation that's just a crappy corporation, that could be hundreds and hundreds of homes. So I understand that people are sort of blank, but I mean, it's sort of like that black and white area, sort of being like you're either good or you're bad. So it's like corporations are either good and bad. It's like, no, it's really, there's like everything's in a gray area, right? There's some great corporations like you guys that will do a phenomenal job of running their properties, and you'll probably get a better service than going to a single family, let's say, single family landlord that only has a couple properties, because you guys are set up to do it. But that comes back onto the tenant's point of view. It's like you sort of need to really do your research and look out there in the market of who's sort of like who are the renters, who are the landlords. Because I mean, like at the end of the day, if you're going to rent a place, like you can go to a corporation, they might be good, but I mean, if you don't do your research, they might be crap. But you could also go to somebody that owns one single family home. They could be amazing, but they could also be really crappy as well.
Terrible.
Right? So yeah.
In fact, there's websites now that tenants can review landlords, so you can like Yelp for landlords, which is challenging for corporate owners, because like you really got to pay attention to this. But some people don't care, and so that's like that will be the signal for the tenant. I agree with that. I hadn't thought of that, but look, the world of social media and internet accessibility to data that didn't exist. We didn't have landlord centric web review websites 5 years ago. It's like in college, when I was in college, you couldn't go rate your professor. Now you can do that. Like, how is this guy? Is this this lady teacher? Are they good or are they bad?
Yeah.
It's actually amazing that exists.
I think it's super interesting. And as I think it was Gary Vee or somebody like that that was saying, like, the internet has just made it like everything that you are as a human, like as you are a being, if you're a nice person or you're a bad person, social media is going to show that. So in business, any world, like you can't really hide being an asshole anymore, right? Like people are going to know and it'll come out. And that's what's happened with like social media, right? Is like, this has taken a little bit another turn, but I mean, like just talking about this for a brief second of, you're seeing what's happening with social media, like actors and all this stuff that's coming out about them and stuff. And it's like social media is sort of leveling the playing field of like, if you're a dick, it's going to come out. If you're amazing, it's like, if
it's going to find you sometime, it's coming. If it hasn't arrived yet, it will be. No, that's so true. In fact, I'm a big believer in the concept, identity, which, you would get, but it's like your reputation. Like, how do people who know you personally, social media, in business, like how do you appear and project out into the marketplace? And we, as many people do, work specifically to build our identity, to protect it. People might call it reputation, but to me, it's more than that, right? Reputation sort of has a certain old school and to work to build trust and have people know you and speak well of you because you did something, like, you produced an accomplishment or you took care of them, right? Like, it's always identity to me is related to an orientation of helping people. And being a value in the marketplace, right? That's how I think of identity. Reputation has a little bit, just more pure social, how do people think of you? But it's like, how do people value you? That's where identity shows up.
100%. And I agree with that. But it's great first part of the conversation. I absolutely loved like the first little bit here. It's been absolutely amazing. So now let's now jump into the next part of actually talking about that development deal that you mentioned at the start. So for the listeners, pretty much what we want to do here is sort of start from like the day one sort of approach of like looking at how you found the deal all the way up to, getting it rented and, the project finished. So why don't we start with like the deal you're talking about? How did this deal sort of come across your table?
Yeah, so I'm going to talk about a project called 1029 South Montebello. It's in the city of Montebello. I mean, you guys can look it up. It's on the internet. In fact, we're finishing leasing it now, and then as we prepare to raise, we are raising capital on the fund. But as we prepare for that process to launch and finish, we're actually selling off a couple of assets. Montebello will be one of them. So it actually just went on the market a couple of days ago. So Montebello was an interesting deal. So, you mentioned earlier, like we're out on social media, YouTube. I did for a period of time, I did a lot of work on BiggerPockets. And I wrote actually several really lengthy threads on how to do development, right? Like, in fact, I call this one called Life Cycle of a California Multifamily Deal. And I probably wrote like, I don't know, 30 or 40 posts, but they're really long. And my whole purpose was to describe the life cycle of a deal from the beginning to the end. In fact, if people want to go there and look on BiggerPockets and look for me, you'll see that on there. And part of the reason I did that is just like I saw space on BiggerPockets to talk about development. That's not the typical messaging or narrative that people talk about. And it's not like that never happens, but most people are there for investment and syndication for real estate versus development, right? So what ends up happening is people find this and it somehow resonates with them. And one of the groups of people that find me is people that are working on their own deals, or they have a deal that they think is a fit, or they're a developer already and they want to JV with us. And actually a guy named Francis Moreno approached me found us on BiggerPockets. And he had done this amazing thing. And Francis actually now works with us as an assistant project manager, and then he's actually a partner in our Montebello deal, which I'll tell you about as we go through that. So he reached out to me through BiggerPockets and he said, hey, I have this deal we're working on. It's in Montebello. At the time, it was a 17-unit project. He had bought the land. It had a house on it and a big lot. So a little house, junky old house on a big giant lot, right? And so he and his partner had basically taken it entirely through the entitlement process, a zone change, a general plan amendment, a tract map, which is like about the heaviest, maybe second heaviest lift entitlement, meaning governmental approval process that you could do. And Francis, to all due credit to him, he wasn't a developer, had never done a development deal.
Wow.
And like, I still give him credit. Like, dude, the fact that you got that done, and he's a pretty young dude, really speaks to his tenacity. And then they ended up buying it, they rented it out as a single family home. So what ended up happening, the reason he reached out to me is as they went to go raise capital on the deal. So they got the entitlements, got an escrow, got the approvals, closed on the land. And then when it came time to actually do the project that they had approved with lenders and investors, they were having a hard time raising the capital for the reasons that many in your audience would expect that are in the real estate business. Is that Francis, good dude, honest, like tenacious, but didn't have the background or the track record as a developer. And so people who are in the business that lend and invest in these deals, that's what they look for. They go, hey, have you ever built a deal? Now, this is my first. And what he did was amazing, right? I give him credit for it. So he approached me and just, as I do, he's like, hey, I have this deal, I'd like to talk about it. I could use your help. So we just had a couple phone calls. And after a couple calls, he basically said, hey, I've got some offers for people to buy the site from me, like just get the approvals and then sell it, right? Which is a typical land development move. I said, well, you could do that. And, what's the offer? We talked about this, but the offer really didn't sound very, it was like the dude sounded scammy, right? Like he was going to just not, be fair to them. I said, hey, Francis, let me do this. This is the kind of deal we would do. So let me make an offer to you. We'll develop it together. You become our partner. You and your partner become our partner. I'll raise the capital, and I already have the lending, and we also have the construction team. So let's come together and do a joint venture. So he agreed to that. And so basically that's sort of the land act part of it. In other words, how do you find the land? How do you control the land, get the approvals to do that, right? And then get it ready. And then once we did that and had the agreement basically together to control the land and bring it into a deal together, we then hired the architect, and then they do what's called CDs, which is the construction drawings. So these are now the drawings that an architect would produce in order to actually get plan check, meaning your code requirements and meeting your codes. And the city says, yes, do this, do that. And then you now have a buildable set of plans. And so, just sort of take you through the timeline. So we worked the deal out. Francis got the land, did the CDs, and then you go into plan check. City basically beats you up and says, hey, change this, put this, but nothing like discretionary. So they can't tell you change the color. They can't tell you, no, you can't do the deal. They just look at the deal and say, yes, it meets code or it doesn't meet code. And that's fire and building and, different, like that kind of stuff.
Yeah.
So we got through that. One of the things we did do is that Francis originally had a design that was 17 condo units, and he got a good architect, but he had this crazy design. He had like a Frank Gehry, all the walls were doing this kind of crazy stuff. And I said, hey, Francis, we just want to build a straightforward deal, man. I want like square walls and rectangles and flat surfaces. It's like boring, but there you go. Like boring is easier to execute, right?
Yeah.
So we reduced it to 15 units. And one of the things that did is he had more units, but smaller condo units. They were 3 stories with a garage on the ground floor, but they were like, let's say, I don't know, 1,300 square feet, right? So we did our UTH design, 2 less units, but our units got bigger. Now we do our 5-bedroom, 4-bath. Okay. So we plan check it, we get it approved. Then as part of our, like bringing resources to the table, we had a construction team that is multiple subcontractors that had built several of these UTH deals for us before. So they knew the product type. We got bids from them. We put together the construction budget. We also raised the capital. So we raised the equity actually from an overseas Tel Aviv-based equity fund called SDB. Bunch of young, go-getters from Tel Aviv. So they came in with, I think, like $1.5 million of equity, maybe like $1.3 million. Francis and myself and a couple other partners, we brought our co-invest in, and then we brought the lender, the construction lender that we'd worked with, and brought that together. That was the financing package. So plans are done, they're plan checked and permit ready. We raise the capital, bring all that together. Now we close the land, bring in all the capital comes in, and then we start construction, right? And then we built it out. And so when we started to build it was late 2019, early 2020, right? And this is noteworthy, which I think everybody will sort of get this. About March and April of 2020, we were framing the buildings, right? So we poured all the concrete, all the underground utilities had gone in. We were starting to go up in the air with sticks, and the pandemic hit. So we didn't know at the time, how is this going to affect us? Like nobody's ever gone through this. Like this is new, and we weren't going to stop. Like we kept going. And fortunately in California, construction remained an essential category. So people could still go to the site. They could still work, right? Coronavirus, regulations didn't exist. I mean, everybody was just like, they didn't know what to do. So we were very fortunate that we were essential in construction, right? We could keep going, and that the city of Montebello decided to stay open. This is interesting because a lot of cities basically shut down. All their staff went home or went to home to work remotely to still try to keep the general, management of the cities. And some cities, not ours, but some cities actually, all their inspection staff were laid off or went home. And so we had people at the time we're talking to, they're like, yeah, our project's dead because we graded and we can't get inspections to go to the next step to pour foundations. And so we're basically stopped. We can't, inspector won't come. If you can't get inspection, you can't move to the next step. So we were incredibly fortunate that we were essential. The city stayed open. And then what was interesting, like a month or two into this pandemic, what I didn't anticipate, we're going to be disrupted. We probably go into recession. Clearly the shutdown, shut down economic activity. So I was like, okay, recession's coming. What I didn't anticipate was that a whole bunch of those projects that stopped, Max, freed up a bunch of labor that all of a sudden became available to us. So before you knew it, within a span of about 2 or 3 weeks, we had tripled our framing crew. And so that means instead of doing, X number of units per week or per month in framing, all of a sudden we could do all the buildings sort of like move forward all at once. Like we had enough crews, lumber was available. So we cut about 3 months off of a 12-month project, went from 12 months to 9 months, mostly in the framing stage, and then a few other, drywall and stucco and that kind of thing.
Yeah.
So that basically accelerated us through the construction period. And then we actually got our C of O. Let's see, when did we get it? We got it in February of this year, and then have been leasing up since then until now. And so we're actually I think we have 4 units remaining to rent. So out of 15, we've rented 11. And that ends up being about 5 or 6 units a month in our leasing velocity, which is really robust. And that doesn't sound like a lot, but when you're in a market that 6 months ago, some projects couldn't lease anything. Like I heard stories, at least anecdotally, that people who were like studio units in downtown LA, right, hardcore central business district, mid-rise and high-rise buildings where everybody was leaving, right? Those guys couldn't rent anything. They were like, we can't find anybody because everybody's like, get the heck out of town. I'm going. Our product, UTH, interestingly enough, we build predominantly in what we call urbanized suburbs. So these are the suburban rings around major cities that are suburban in their format, but they're urbanized because they're older, right? So like, Montebello, Fullerton, El Monte cities that we're building in now, these are all like, 50s and 60s era suburban neighborhoods and cities. But, when you got 50 years of growth, you got more commercial, more industrial over this, that, and the, so they become sort of urbanized. And I coined that term, urbanized suburbs. But this is exactly where, when you described earlier, people leaving cities to go to rural, Zillow did a study, and what they came up with is that most people that are leaving the city centers aren't going to far-flung rural communities, as I think was in the mainstream media. What they're doing is they're going, half an hour, 45 minutes, an hour away from where they were to a lower density, more suburban, so they can get a bigger unit, a little bit more affordability, right? They don't want to go to middle of nowhere. I mean, like a little tiny bit of people did do, they moved way into the sticks, but the predominance of people were like, no, I'm going to move 45 minutes away. Because guess what? Maybe they still worked. Maybe they had extended family. There was some logic for them to stay, within that realm. So like San Francisco, you have city of San Francisco in the peninsula, right? City and county of San Francisco. So they went to Marin County to the north, or Contra Costa County and Alameda County to the east, or maybe they went south, but they went like one county over, right? Not like moving out of the market altogether. So anyways, that brings us to today. So we've leased up 11 units. We now have enough cash flow to cover our construction interest monthly. So we're sort of in a good patient position. And we just put it on the market through Marcus Millichap, brokerage here locally in Orange County, through a guy named Matt Wenzel. And we will sell the project. And then what we'll do is we'll sell it. All that money will come in. We have a signed contract. So, oh, by the way, I'll offer, we put it out on a value in the marketplace for sale, well above what we thought, but the rents and the incomes sort of produced and supported this value. And we got 4 full price offers in about the first 3 days of marketing, which is just incredibly fast. So I think just another signal that our product type is valuable, that it's in demand, that we can lease it. Because that's always the question in development. Like if you finish a building and the market's moved away from you, let's say you've gone into recession, you might have units that you can't lease, right? If you're in a high-rise building in downtown LA, like I was saying a minute ago, like you may not be able to lease those, or usually what happens, you have to drop your rents. And so all of a sudden your deal economics start to erode and degrade. We're actually having the opposite. We're accelerating. So we'll sell the property. We have an escrow opened. Once the money comes in from the closing, we'll pay back the lender, we'll pay back STB, our investors, and then what's left will be a pot of profits to share. Some will go to the investors, some will go to the sponsors. So Francis and his partner will get some profits. Myself and a couple other folks will get some profits. So that'd be sort of like the beginning to the end of a development deal. Now, one caveat is we really want to hold these UTH assets for long run. We're such firm believers in the product category, and particularly serving these middle income families, that we really want to own these buildings for forever, in perpetuity for all intents and purposes. But two projects, Fullerton and then Montebello, strategically didn't fit into the structure of our equity fund, the Urban Pacific Workforce Housing Fund. So we did some strategic divestment, but typically we wouldn't sell it. So for like your listeners, if you don't sell it, then what you do is you get a perm loan and you fund that perm loan. That money comes in, and then that's money to pay back the construction lender, because the construction lender is a short-term lender. Your perm lender is the long-term, say 10 to 30-year money. So typically you'd fund your perm loan, pay back your construction loan, and then your investor, depending on whether they want to stay in or get out, like you have to arrange that. But really, Montebello is an anomaly for us now in the fact that we're even selling it. When we complete the capital raise for the fund, that will then be a longer term hold, which was sort of produce the long run values and orientation around this multi-gen housing that we really are focused on.
Yeah. Like that's
that was a ton. So
yeah.
Tell me.
But yeah, like that.
Tell me what questions you have.
Yeah, awesome. Actually, starting at the just a few questions, just starting at the beginning there. Like the 17 unit project. There was a lot of costs that you mentioned that are sort of upfront, which is like buying the property, getting the plan permits and all that type of stuff, and and how you're sort of structuring it was, you buy the property, you do the plans, and then you raise the capital. So it seems like you sort of have to eat an upfront cost at the beginning. Is there a way to sort of get around that at all, or like let's say,
yeah, it's a great question, Max. It's the classic rub for developers, because you always have some pursuit costs, right? Some upfront. Now, the way I describe Montebello is it's a little backwards for how we typically do it. So the normal way would be we'd find a piece of land, we'd put it in escrow, and we'd have an escrow deposit, and that's some of the upfront money that you have to do. Okay. And then you would do your due diligence. And let's say you're doing this report, you're doing a phase one, and you're doing soils, you have to pay that. That's more pursuit costs. And you want to know the answers to those questions from those reports before you buy the property. So in escrow, right, you've tied up the site, you legally control it via PSA, purchase sale agreement, or a contract, right? And then you want to do your homework, your due diligence during that period. So that when you buy this property, if you decide to do that, that you've answered all the fatal questions, like, do I have a nuclear dump underneath the ground here, right? Like, is the dirt glowing? Oh, if it is, we're not going to close on it. Mm-hmm. Or more likely, you used to have a gasoline station and there's an underground tank, and you can build on that kind of stuff, but you got to clean it first. And so if you find a tank, or you find, soil that's been impacted with oil and gas, you're going to make a decision. Do I go, no go? For us, it's usually just flat no go. We just don't do those kind of sites.
Yeah.
And then you'll want to develop some of your architectural plans, what we call schematics, right? So you just want to lay units out on the site just to know that the deal works. So what I mean is, if we back up a little bit further, before we put the land in escrow, we'll identify the land parcel. Like, we're doing land acquisition. You go, oh, I got a 2-acre site. Cool. Looks good. Seems to be the right price, right zoning, right location for what we want to do. And then we'll do a yield analysis. We say we can fit X number of units on that site, right? For our product, UTH is 22 to the acre. So if we had a 2-acre site, the easy math is 2 times 22. So we can fit 44 units on that site, right? So then we do that, but that's just math. That's not physical. That's not designing units like on the site. But we need to assess the site from a pro forma standpoint to know, is it even viable? Because if it's not viable, right, if we can't fit 44 units, we really can only fit 40, but the price that we want needs to be sold at, or what the seller wants is, needed to have 44 units. Well, you need to know that, right? So you do yield analysis, 44 units, then we'll plug that into a pro forma with all of our historical build cost, land costs, the rents we can get, the operating expenses that we use, and we'll model the project and say, does it work or does it not? And then if it does, then we'll make an offer. And if it's accepted, then we put the land into escrow to control it, right? So before you ever even spend any of these pursuit costs, you've done an analysis, doing your basic assessment of the site. You've run numbers, you think you can fit 44 units on it, right? You get into escrow, you do your due diligence. Well, one of the things you'll do is you'll give the site to the architect and you go, hey, dude, I've got to get 44 units on this site. Like, lay it out. Let's see if it works. Sometimes I'll talk to the architect ahead of time. So if it's a site that comes along, I've done some analysis, I think it looks good, I would then like send the site to the architect and I go, hey, what do you think? I think 44 units here. What do you think? And I go, don't even lay it out. Let's just sort of like just block and tackle a little bit right here. Do we have the right width, the right depth? Yeah, it's a unit's 21 by 35 is our unit footprint. We have a 24-foot driveway. We have another unit on the other side. So we need X amount of width to fit like our typical design.
Mhm.
And so we'll do a lot of like upfront homework, talking with our team, like having conversations, designing, like even mentally and just like roughly, right? Super rough, because we want to keep costs down, time, energy, and money as much as possible. Because think about it, if you're a relatively, volume focused developer, I mean, you may look at 100 to 500 sites like a year, and you may
Yeah.
underwrite,
Yeah,
50 to 100 of those.
yeah, that's one thing I wanted to mention was like if you're having to pay like all these upfront costs a lot, I was like, how do you guys sort of navigate that end of being like, what you guys are doing about like
Yeah.
high
You would
volume?
never do it until you knew the deal worked. And then the original question was, these pursuit costs, that's usually money out of pocket. We have to fund that. It's just money that, we like when we make profits from deals or we have cash flow, our own money that I originally invest in the company. We have a pool of capital that's available for these pre-development or pursuit costs. If you were a new developer and you just were getting into the business and you didn't have any money, go find a partner, right? Hey, Joe, hey, I got this great site. I underwrote it. The deal works. I got I get the purchase contract. I need to raise 50K because the escrow deposit's 10, the due diligence is another 10, the architecture cost me $2,500. I'm just making these numbers up. You get the point.
Yeah.
And so you will now the reason that money is so important is because it can be lost. In fact, it's the most at-risk money that you will ever have in a deal, because you may spend that money and then get to the end and go, oh, dude, it's got a tank on it with gasoline, and I've already done all this other work. Well, you lost that money. I mean, and I'm not like happy about that. But what you do is you really start to ask as many questions up front. Is there any toxics on the site? Can I fit this? And you do all that at little or no cost, as much as you can.
Yeah.
So each step that you're making, you're increasing the risk and the need for pre-development money, but you also don't want to do that until you're satisfied that you've answered as many questions as you can before you make that next step. Because at some point you may run into something that's just, reality says you can't do this site, right? And then you will have mitigated risk at each step as much as you could, so you lose the least amount of money, right?
Yeah.
Because developers will always tell you the reason that that upfront pre-dev capital is the most at-risk money and the hardest to raise if you have to raise it is because it's very easy to lose. And in fact, it's the most commonly lost money. And in fact, every year we write off X amount of pursuit costs. And, I'm not troubled by that. I myself and our teams, were always making the best decisions we can in the moment. And occasionally you run into something, you go, oh, I didn't see that coming. Whoop, we got zapped, and, we spent 20 grand and out the door. And 20 grand is like peanuts for some people. I know developers that spend hundreds of thousands of dollars. All I will say this about myself, I am notoriously good at being super frugal at, spending pre-dev capital. And I don't mean foolishly. Like, we still have to answer the questions, appropriately and professionally. but, I work out deals with my vendors. Hey, do this work up front and, do a yield study for me, architect. And I will, if we get the deal, you will have the work. I'll promise that work to you, but do me this little drawing up front at no cost. Right.
Mhm.
And I have a team that does that.
Yeah.
Some vendors, they can't do that because they have to pay their people and do
Yeah.
reports and pull data. And so they have to charge
So,
me.
so, so,
Um,
yeah, yeah.
yeah, go for it.
Yeah, yeah. I was just gonna say like that's something that you mentioned was so crucial. There was like that, like all that type of stuff, for like being the frugal, and but having those people do that sort of upfront stuff, that really comes back to relationships, and you must have a great reputation in your sort of market already. So yeah, hearing that is like absolutely benefit, like a huge benefit.
Well, we build those because like some developers, they don't do that with the architects. They just, like I know people that they get a new site, they'll give it to an architect and they'll spend 25K, like just like it's nothing, and then find out the deal doesn't work. And they do that. Like I know some developers and people who are in the professional development business who listen to this will know this example is a bad example. But I know people that over and over and over again pay their architects a lot of money. They do beautiful designs, but then they find out the deal doesn't work. And they keep doing that. Like one particular company, I won't mention any names, and I even advised this company, I said, you guys don't need to spend all the money. Don't do all the fancy renderings and beautiful stuff. I mean, beautiful plants, Max. I mean, just, you just, wow. Like you get chills looking at it, but you go, but it doesn't mean anything if the deal is dead.
Yeah.
Right. If you did fancy drawings and then found out there's a nuclear waste dump on your site, you ain't doing the deal. Right. So this sort of discipline that comes with, by the way, losing money, like all these lessons that I'm sharing with you guys, I've lost money at every step of the way, and not enough to like add up to like defeat, but just little things here and there, and you go, yeah, oh, I did that. That went against me. Don't do that. Don't do that. Don't do that. Right. So eventually come up with this framework of ways and things to do it. So the idea I gave you, the architect, I worked that out because I saw so often we would spend money on upfront plans on a deal that didn't work. It's like, oh God, we got to get a way around this. And so I built a relationship with one particular architect. In fact, he's been exclusively doing all our work for several years now. And I said, the deal is, look, I need all these upfront, simple. I will lower your cost. I'll try to do as much of the thinking and design around the yield analysis that you'll do at first, but just lay it out. Just give me a little basic drawing. I don't need anything fancy. Just fit 13 units or 44 units on the site. Can we do it? Yeah, cool. And, that's not to say it's perfect. Maybe later you can only get, instead of 44 units, it's 43, but we deal with that, right? But I said, the deal is, if you can give me that up front at no cost, I will always give you the work when we get the deal.
Yeah.
If we don't get the deal, you don't get the work. But if we get the deal, it will always be yours. And, we worked out fair pricing. So, there's always good economics for that team and our team.
Yeah.
But we specifically design that. And we do that everywhere we can, that's available and a possibility. And that's just one example. And you talk to any developer and they'll have somebody in their team who they have that kind of deal with. But that allows us to be good at assessing sites at low cost. We get to take care of the architect because they get a lot of work from us. In fact, I would, propose that we're probably that architect's biggest client. They know our product, they know our style. They're fun to work with. We like them, they like us. That everybody's happy and and professional. So I just but that's some specific we designed to lower that cost up front, because you need to do a lot of that over and over and over again, assessment of sites and a lot of stuff. In fact, my joke is when I was a young project manager, like there's no deal I couldn't do. Or maybe I said this when we talked before. Every deal was possible, man. Hairy, tough, bad politics, environmental issues. I could solve that problem. I could do that deal. Now I'm like, dude, there's like almost no deal that I will do. Like almost everything dies. No. Like I was doing a video today with some of our interns. Like I'm building a series of online courses, and we're going through the land acquisition process. And I took them through my process, and I go, I can do mental math on look at a site. No. And I may do that hundreds and hundreds, thousands of times. And then every once in a while, a site will go, oh yeah, it fits, right price, right zoning, right location, this size, whatever the criteria at the moment is. And, you do that on purpose, right? Because the goal is to go through as much junk as fast as possible at low cost possible to find the good stuff.
Yeah.
Because when you're a young entrepreneur, a young deal maker, or a new developer, like you get fixated. I see this all the time. Somebody new, they found that site, and man, they're going to die on that hill, Max. They're going to die on that literal hill, right? And you go, dude, like you look at it, you go, oh, that's a terrible site. Like, what are you doing, dude? Oh man, it's like this and this. I go, no, man, like get rid of that thing. And they're like, it's hard. And I get it. Like I was there. Like every site, you should be able to make it work. And you go, no, that's not the point. The point is to go through all the garbage and get rid of all the garbage as fast as possible so you can get to the good stuff sooner. And you could say the same thing if somebody acquired apartment buildings. Let's say they're an investor or syndicator. Your goal is to underwrite as many deals as possible and get rid of the junk, and then find that, 1 out of 10, 1 out of 20, 1 out of 50 apartment buildings that's the right value, right location, right discount, right rents, or future growth for rents, or you're doing value add. So it's the same thing. I think that just becomes with seasoning. But what I do and train with teams is like, how do we teach you guys how to do that earlier, right? It took me, a long time to figure that out. Now, when I have people on my teams, I go, let me teach you how to do that early. Francis, who works with us, as I mentioned before, he brings me sites, and we worked on a site. Actually, it was a city-owned site here in Southern California, close to his house, right zoning, right price, all this good stuff. But the city was difficult, and the city wanted another developer, not us. And so Francis, he said, Scott, I just can't give up on this thing, man. And I go, Francis, I get it. Move on, track it. Maybe it comes back, right? Stuff comes back sometimes, I've seen it happen. Maybe never, maybe sometimes. Go put that energy into other deals that where they do have a cooperative this and a good that and an underwritable that.
Yeah, 100%. And that's actually funny that you're bringing that up, because I was just thinking about that from my point of view. And I'm slowly building like a small video editing agency and stuff like that. And it's sort of similar to clients, right? Like clients are the same as like the deals, right? Where it's like at the beginning, I'm trying to do whatever I can for every single client. And some clients are maybe not the best than others. And at the beginning, because it's like you don't have the opportunities yet. You aren't at that level where you're getting that enough business or looking at enough deals.
So you want to take every opportunity you can.
Yeah, and you just try and hold on to. I pretty much hold
on.
I
need any deal, man. Bring me any deal. I'll take it. Yeah, right. So in your sales conversation with new clients, right, as you get more business, you start to qualify them more.
Yeah.
Like how's their personality?
Yeah.
How do they value work? What are they willing to pay?
Yeah.
Why are you coming to me? Where's your last video editing agency? Well, like what happened, right? Or whatever you would ask, right?
Yeah.
You know what it is? It's qualifying. It's like it's qualifying a sales opportunity, a person, a deal, whatever, right? And the more and better you qualify, the more successful your sales process is ultimately going to be. Now, for you, it's finding clients, and for us, it's finding deals, but it's the same process, right?
Yeah.
It's the same like sort of disciplined application of criteria and standards to a qualifying process. And dude, it's hard, man. Like you're right. Like I'm in the beginning, you're like, dude, I need any deal. I need any deal. I need any deal, man, right? And I go, no, dude, no. Like you need, you don't need most deals.
Yeah.
Right? You'll get it. You get that client, and they'll just saddle you with like, what is it? I'm on social media a lot. And so I saw somewhere the guy was like, the $500 client versus the $5,000 client, like, huge difference in how they value your work, right? How they treat you. And I'm not, again, there's always good and bad, like we talked about before.
Yeah.
But it's getting to those deals and those people that are like higher value, the idea of value is respected, and like true, like the work that you do is valued, right? Those are the best clients, man. They're
Yeah.
like, dude, I'll pay you whatever you need. Your work is good. You take care of me. I take care of you. Go.
Yeah.
Right. They want their time, and they'll pay you whatever they need to pay you to get the stuff done, professionally, versus
Yeah.
the $500 person's like, can you give me this? Can you give me that? I need the extra. And you're like, your hair's going away.
Yeah. Yeah. I know that sorry. I don't know.
No, it's good.
Yeah.
It's very fundamental in business, and human. All business is human business, right? So it's
Yeah.
always people, whether it be deals, real estate, video editing, whatever have you. So like
Yeah.
the idea I gave you with the architect, that's human business, right? I work that out with that guy, that person, not the company, not the LLC, not his.
Mhm.
I mean, his team is there too, but yeah, and that's become so fundamental that it shows up everywhere, right?
Yeah.
That's
Yeah.
like just everywhere you go, there's going to be people. It's social interaction to produce transactions and business and value, right? And you can really always, if you approach it this way, if seeking and delivering value, and in a transaction, like I give you this service, you pay me, you give me your money, I give you my service. You got the land, I got the deal, right? We do that. It's very fundamentally, and it's the same throughout.
Yeah. Like 100% on that. So yeah, I know we're coming to the end here, and it's been absolutely phenomenal speaking with you. You dropped tons of knowledge. One thing you did mention that I thought was really interesting. So I heard, I don't know if I heard this correctly, but do you have a course coming out?
Yeah, so I'm working right now. We're building, so it'll be under my personal brand, scottchoppin.com. And so we're gonna have ebooks. We're gonna have a video course, but that's gonna be a little while. Like, we're building it now, but the ebooks actually be up in the next few weeks. And it's all around the same stuff, like how to underwrite apartments, how to research zoning, all real estate development knowledge. So if people want to go look at that, probably sometime next month, I would say that'll be up and running. But yeah, the idea is to like bring forth the knowledge that you described, and real estate development is an obscure industry. Like, you don't go to high school counselor and they go, oh, your test results say you want to go into a career of a real estate developer, man. They don't even know what that is. And I'm not saying they're bad people because of it. It's just one of those businesses. Like, I get like, okay, so you're a developer. Like, I don't know what that is. Like, you build the buildings, like, you do construction. I go, well, we do construction, but I don't do the construction, but we hire people. So, okay, you don't do that. We design them. I go, well, we do that too, but we hire architects to do that. And they're like, well, dude, what do you do? So what I tell people, the example I give, it's like being the conductor of an orchestra, at least as people know it, right? They don't play the instruments. They didn't write the music. They probably work for the Philharmonic, organization, but it's their job to bring it all together to work. So they hire the musicians, they recruit the musicians, they interview them, they pick the music, they'll work with the people who bring the capital and the assets, the hall together. And it's their job to bring it all together into a cohesive whole, so that then it produces value. Again, back to this idea of value. Now, for them, the value is people sitting in the audience, enjoying the music and paying for a ticket that then, produces the economic, cycle for them to remain as a viable entity, right?
Yeah.
And so we're the conductors, a developer is a conductor of an asset, right? The creation of a brand new apartment asset that rents to people who pay the rent, right? And we bring the capital and the design and the construction and the land acquisition and the governmental approvals. Like, we bring all the teams and the knowledge together to then bring the cohesive. So it's entrepreneurial. Like, I would describe myself as a real estate entrepreneur. Anyways, having said all that, what we're bringing forth would be, a base of knowledge and ebooks and video courses for somebody who decides. Really, the two main people that we're thinking of would be somebody who's younger, who's thinking about real estate development as a career, or maybe they're a young entrepreneur. And I've come across examples of both. So Francis Moreno would be the the example of a young entrepreneur who's trying to launch a real estate development, but has a lot to learn, right? Young career person is like, I had an intern who worked with me who was with us for a while. He was able to sit in interviews as a project manager, to be hired on for real estate development, company. He's now a full-fledged career in the real estate development business. So that's group number one. And then group number two is seasoned entrepreneurs. So the example I always give is Michael Blanc, great podcaster, real estate syndicator, sponsor, investor in the investment and multifamily investment domain. And I did his podcast, and we ended. He's like, "Yeah, Scott, I've always thought," and I'm paraphrasing. So he said, "I've always thought about development." But he goes, "Dude, that business scares the heck out of me. Like, complicated, risky." And so the second group of people that we work with in both our training, and we also have a consulting, coaching offer, is to say, "Hey, look, you have the deal. You want to do the deal. Maybe you're a seasoned real estate entrepreneur. You want to launch into this real estate development domain. We'll help you with that." And in fact, we have a team of people who do our advisory work, who basically help people who have, development projects that they need to execute on, or they want to, help to execute on a deal. So everything comes from that domain of helping people launch successfully into some sort of real estate development activity. And so why I say it that way is because everything that we produce and content and the articles we write, all the bigger pocket stuff I did, the ebooks, and eventually the training courses and the advisory and the consulting, is all to facilitate that. And of course, we're here to produce business. Like, I need to make money to take care of my family, and we do that. Our main business is real estate development and the fund and future funds. But I've always sort of been oriented around, I had great teachers, and, although we're a profit-centered company to convey this knowledge, the way I put it this way is the stuff that we teach can help people make hundreds of thousands, if not millions of dollars, right? The knowledge that we have is that valuable, right? And most people don't even know what the career is, right? And that's fine. Again, but I think in this go forward realm of high inflation, of movement from a fiat to a cryptocurrency world, the ability to produce valuable hard assets, right? Like apartments or real estate deals, like the creation of new ones. Like, you can buy and sell apartment buildings. Like, that's a very viable business. It's super competitive. What we do is we create new assets that didn't exist before. And that's the real key difference. Is you can buy and sell existing assets. We say we create it from zero to existing that didn't exist before, right? And that's going to be, I think, a really powerful offer. It has been for many years, for hundreds of years that developers have existed, just on a go forward basis. And then the last thing I always think of for us is housing guys, as apartment developers. The reality, housing is always going to be a fundamental human biological need. We will never, as human beings, I mean, people do live without shelter. I'm not saying that you can't survive, but to live a good life, to live a viable, valuable, healthy life, you got to have shelter. And so what we do is we provide human beings with the basic need for shelter. It happens to be rental housing in urbanized suburb. It's got the format, but that will never go away. Right. Same as, eating and breathing is a fundamental human need that housing and shelter is.
Like 100% on that. It's been an absolute pleasure having you on the show, Scott. So you have your course coming out. So yeah, guys, if you made it all the way to the end, thank you for listening. I appreciate it. I highly recommend, if you're interested in getting into the development space, I highly recommend that you go check out some of Scott's blogs and other stuff he's posted on Bigger Pockets, on LinkedIn, on his YouTube channel. It's tons of really good information, and it's a great place to start educating yourself and figuring out how to get into this industry if you are new at it, or like Scott was saying, if you're an experienced investor and you want to take your sort of in real estate business to the next level and start developing, you're going to be having a course that's coming out. But thank you again for Thank you again for coming on the show. Where can people actually,
Great to be here, Max.
where can people actually find out more about you? I know that like.
Yeah. So yeah, appreciate that. I would encourage people, they can go to our company website, www.urbanpacific.com. If they want to go to our investor education section, if they're interested in acquiring knowledge about real estate development and the apartment marketplace, we got tons of stuff in there, like you said. When you're there, hit the red button that says sign up, and we put out a Saturday e-blast every Saturday, which is a series of articles and writing that we produce, and we put our podcasts that we're on there. So this one will be on there in the future. But get on that Saturday blast, and what that will be is sort of a combination of knowledge, but really more about economic cycle tracking. Like, what's the apartment market doing? What's the future of inflation? We talk, we're not, Bitcoin centric, we do invest in those markets. So every once in a while, if we think there's a, the real estate meets blockchain crypto marketplace, but it's all about the real estate markets and trends. So the Saturday blast does that. And then the website will just be more like, standard, but a lot of depth of articles and videos and stuff that we have. I mean, you could go in there, and if you went through it all, you basically have already a great education in the real estate market. So go there. And then, if anybody wants to get a hold of us, our, contact page has everybody's email addresses on there, and you guys can get a hold of us that way.
Awesome. Well, thank you again, Scott, for coming on the show.
Great to be here, Max.